Hi, my name is Rodney Ramcharan, and I'm a professor of finance at the Marshall School of Business. And in this presentation, I provide a brief overview on the policy response in Washington, D.C. to the COVID-19 pandemic. A good way to begin is to provide a brief description of the way the economy functions. Most of our goods and services are bought on Main Street, and so we could think of Main Street as where we get our ice cream cones and where we get our haircuts. Many businesses on Main Street depend on the banking system for external sources of finance. These can be funds to help make their payroll, or these can be funds in order to invest in plant and equipment. Now, banks get a lot of their financing from the financial markets. We could think of these markets as the bond markets, and we could think of these markets as equity markets. In addition, some of the bigger businesses on Main Street depend directly on the financial markets for their sources of funding. You could think of major corporations that we know of, like GE or Ford or GM, as issuing bonds or issuing debt, which are sold on major markets and are bought by investors on Wall Street. So in a modern economy, we could think of Main Street as depending both on the banking system and on the financial markets for broader sources of funding. Moreover, we could think of banks as being interlocked with the functioning of these broader markets. So we can think of the pandemic with orders such as social distancing and sheltering in place as creating a sudden stop in the cash flow to Main Street businesses. So this is a liquidity shock that effectively says that the local ice cream parlor or the local haircuttery can no longer accept payment, or people are not allowed to go to these businesses. This complete stop of cash flow means that the payments that these businesses normally make to banks have now stopped, and the payments that these businesses normally make to the financial markets in terms of either making their dividend payments, if these are major corporations, or in terms of making their debt payments, if these are firms that have borrowed on these markets, those payments have now stopped. So therefore, what the pandemic highlights is that the sudden stop of cash flow on Main Street directly affects the flow of funds to the banks, and it directly affects the flow of funds to the financial markets. These institutions on Main Street now need external sources of financing in order to survive. Likewise, the financial markets and the banking sector also need help in order to offset the sudden stop in the flow of payments that they depend on. So we have seen that in a modern economy, Main Street, Wall Street, and the banking sector are closely connected. And we've also seen that the sudden stop in cash flow on Main Street is going to affect all of these different components of a modern economy. So in keeping with that idea, the Federal Reserve and policymakers in Washington have put together a series of policies intended to address the pain at each of these pain points. In the case of banks, what the Fed has done has put together about 5 or 6 different policies. Policy 1 is a sharp cut in the federal funds rate, effectively from 1.5 percentage points down to 0. The federal funds market is the lending market in which banks operate and lend to each other short term at an overnight interval, and the interest rate in that market is determined by the Federal Reserve. The 150 basis point cut is unprecedented. Typically in that market, the Fed operates a 25 to 50 basis points interval, and so this is a striking policy step. In addition, to help to lower the cost of credit longer term, the Fed has pursued a policy called forward guidance, where they have promised to keep short-term interest rates low for long. And the idea here is that most consumers and firms borrow longer term, out 6 months, 6 years, or out to 30 years in the case of a mortgage. The Fed only directly controls the short-term rate in the federal funds market, but most of the longer-term rates in the economy can be thought of as an average of the expected short-term rates. And so if the Fed promises to keep short-term rates low for long, that means that future short-term rates are going to be held low, and that's going to then drive down, the theory goes, the cost of borrowing for longer term. A third measure is built on the fact that banks are heavily regulated, and often those regulations increase the cost of doing business. So the banking agencies in Washington, including the Federal Reserve, has decided, once the crisis became clear, to relax some of the regulations on banks in order to reduce the cost of doing business and enable these institutions to lend more aggressively. In addition, the Fed has a discount window, an operation that allows it to lend directly to banks in exchange for the collateral that a bank might post. What the Fed has done is that it has lowered the interest rate on that discount window, and it has also reduced the level of the collateral quality that it will take in order to lend. Finally, you may have heard of something called quantitative easing. And what this is the Federal Reserve's promise to buy US Treasury securities and to buy something called mortgage-backed securities. These latter securities are the securities that are comprised of the cash flow that people have from their mortgage payments. And by promising to, in essence, be a massive buyer of these kinds of assets, the Fed hopes to push up the price of these assets, and many banks hold these assets on their balance sheets. So by pushing up the price of the asset, it imparts the capital gains to the banks, which can then allow them to be more profitable and to lend again more aggressively. We now discuss some of the policies intended to help markets function and to keep them liquid. One of the most notable policies is quantitative easing. As we just discussed, by promising to buy large quantities of treasuries and MBS, the Fed is effectively saying that anybody that wants to sell these assets can quickly find a buyer at the Federal Reserve, thereby preventing the disorderly liquidation of these assets and causing large spikes in interest rates. The Treasury market is one of the principal markets, so the interest rate in that market is one of the principal rates of which all other assets are priced in the economy. So by promising to keep those rates low, the Fed is effectively preventing rates from rising elsewhere in the economy, which makes it easier for firms and for households to get access to credit. Other separate markets are just as key. There's something called the money market mutual fund market, and this is a market where large depositors deposit funds at money market mutual funds, and these funds turn around and buy assets like treasuries or bonds elsewhere in the economy. And a concern is that if the depositors that are investing in the money market mutual fund business, if they begin to rapidly withdraw their deposits from the money market mutual funds, then these funds will have to liquidate the assets that they own. And that disorderly liquidation can again lead to significant spikes in interest rates that can be problematic for firms and households. So what the Fed has done is it has said that it will effectively backstop these markets, will promise to buy all of the assets, and that way it will prevent runs or the rapid liquidation that can occur in these markets. The repo market is a major market where where market participants like hedge funds and broker-dealers trade overnight. And the Fed has stepped in and has also said it's going to backstop the operations in these markets, which will take away some of the uncertainty and help keep interest rates low. There's also something called the commercial paper funding market, and the Fed has said it will create a facility that will buy all of the commercial paper at a given price of a given type. Commercial paper are short-term bonds that are issued by major corporations over 20 or 30 days to help them finance their payroll and their short-term funding needs. By having the Federal Reserve step into these markets and promise to buy these assets, the Fed is effectively keeping interest rates in these markets stable and again helping corporations to gain access to credit without significant spikes in the cost of credit. We have discussed some of the policies to help banks and to help keep credit markets functioning. Many of those policies were first seen in 2008 and 9. However, the current pandemic is a sudden stop in cash flow to businesses on Main Street, and the Fed has, in essence, now designed a whole new set of policies that are unprecedented in their scope for any central bank. And these policies are intended to directly help Main Street. These policies take the form of the direct purchases of bonds from corporations. That's the primary market policy. Also, the Fed is buying already issued bonds, i.e. that are already issued by corporations in the secondary market. And in a really incredible step, they are also getting into the business of lending directly to small businesses, whereby operating through the Small Business Administration as well as through banks, the Fed is the backstop or the clearing agency that's going to send funds out as authorized by Congress to these institutions to get them to lend to the smaller firms in the economy. Will all of this work? Well, some of the policies, as I've said, were tried in 2008 and 9, and researchers have examined the effectiveness of these policies, and what we know is that they did seem to have an effect in limiting the damage from the crisis. So take, for example, the commercial paper funding interventions that the Fed did. That tended to lower the cost of credit, make credit more easily available to firms. And in the case of cars, we know that the captive car lenders were able now to get credit and then come and extend that credit to consumers. And that arrested the collapse in car sales. Some of the interventions in QE by lowering the cost of long-term credit for major firms, that helped to induce these firms to invest and to employ people. So we know that some of these policies were effective. And also QE and TARP, some of the capital injections into the banks that the Treasury undertook, did increase the profitability of these banks, did reduce the incidence of fire sales, whereby banks would sell off homes at steep discounts. And that helped to make more stable the housing market and to push up prices in that market. So what we can say concisely is that some of these policies have proven to be effective when used in 2008 and 9. So the big question now is whether these policies will work again and contain the crisis. And the short answer is we don't quite know. I think it's going to depend on how long the pandemic continues. If it's short, if it's long, it's going to depend on getting money to small businesses. Recall in 2008 and 9, all of the policy interventions were geared towards the bigger firms because that's where the crisis started. That's where the focal point was. In this instance, the crisis is on Main Street, and we don't know how or whether the money will get to these firms. We then don't know how much people will be laid off, right? We don't know if these firms will begin to break apart as they fire their workers and idle their capital. And so these are all some of the big questions outstanding. There's never been a pandemic before in a modern economy, and it's difficult to give a forecast. What I can offer are three scenarios, and I don't know what the likelihood of these outcomes are. Outcome one is what I would call the good outcome. And in this outcome, money gets to small businesses quickly and a vaccine is found soon. So money getting to small businesses quickly means that they don't have to fire their workers and they could keep their capital stock. And a vaccine being found soon means that the economy can resume and that the sudden stop in cash flow ends. The bad outcome is that the money gets to small businesses quickly, but the vaccine takes a long time. So the businesses keep employees and keep capital, but human capital and capital begin to depreciate while we wait for a vaccine. So while there isn't unemployment, when the vaccine comes and capital and labor are again put together, they're not as productive as they used to be, and so the recession continues for a little bit longer. So the most worrying outcome is the worst outcome. And this is the outcome that happens if the paperwork is chaotic and credit does not flow to firms, and so these firms fail and are forced to lay off their workers. This outcome is also possible if there's a lot of political intervention that leads to a misallocation of credit, that credit flows not to the most productive firms, but to the most connected firms. And so these firms may not be the most productive ones. An outcome from all of this is that a lot of firms fail, and the ones that survive are the politically connected firms who are not the most productive ones. That is what you call a misallocation of credit. It's going to lead to weak economic growth, and it's going to lead to greater political discord. Why those things are worrying is because US debt levels have gone from 50% of GDP in 2000 to about 110% of GDP as of 2019. With all of the expenditures to contain the crisis, estimates are now putting US debt to GDP at somewhere between 110 to 115, 116%. If the policy interventions are ineffective and they leave behind a legacy of high debt and weak economic growth, then that can lead to significant economic problems. We may not be able to grow fast enough to pay off the debt, and then investors and businesses are going to have to worry about high future tax rates and/or inflation. I don't know if that's a likely outcome, but I think it's an outcome that we need to consider carefully as we assess what is the right way to deal with the pandemic.